Personal finance practice problem using OneNote. Decision to buy appliance net present value type calculation. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 6160 Decision to Buy Appliance Net Present Value tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at a scenario of thinking about purchasing a fairly expensive appliance. That being, we're going to assume a dishwasher in this case, although the same concept can apply to anything of a similar nature, of a similar cost. We're going to be using a net present value type of calculation, a typical calculation often used by businesses when considering long-term type of purchases, such as purchases of equipment. When doing this type of calculation, because we're impacting multiple periods into the future, it's often useful for us to be taking into consideration the time value of money. The basic concept then being that we break down both the benefits and the costs in terms of dollar amount. We try to break those dollar amounts into flows that happen on a periodic basis, typically yearly, and then we present value those cash flows to think about what the current amount will be using a discount rate which takes into consideration the rate of inflation and the rate of an opportunity cost to us. So let's look at the scenario here with regards to something like a dishwasher. If we're saying we got a dishwasher, it's going to cost $3,000. We're going to assume we're paying cash for it. That means $3,000 going out up front. The money going out is easy for us to determine. We know what the value of the cash going out is. It's dollars today, which is $3,000. Now, the benefit we're going to get is a little bit more confusing, because if it was a business scenario, we would be putting money into the dishwasher in order to generate revenue in the future, then try to determine how much revenue or reduction in cost possibly we would have from the equipment purchase, and look at that cash flow to determine whether or not the cash outflow up front would be worth the cash inflows in the future, or reduction in the more efficiency in the future. Here, however, our goal isn't to generate revenue per se. Our goal is to make our life easier, to save time in the future. Therefore, in order to do this type of calculation, we would have to come up to some calculation of how much value is the time that we're going to be saving with, in this case, the dishwasher. So then that would mean if we've got a more efficient dishwasher, a bigger dishwasher, better dishwasher, what kind of benefit are we getting in the future from it, and try to annualize that benefit so that we could do the same kind of calculation. So if we say that we're going to save per year in time $1,040, and you could calculate this something like, you think you're going to save time per year of $15 times a number of hours per year, that you're going to say per year. You're going to say like 5 hours on dishwashing per week times 52 weeks would be 260 that we're going to have there, and then we'll take that and say times like $15 or something like that. These are some ways that you might try to estimate the value to you. This, of course, can be difficult because you might be buying the dishwasher or some other appliance for other reasons too, which might just be you just think it would be nice to have a nice dishwasher. You like just the aesthetics of it in your home or something like that. And it can be difficult to put a dollar amount on it, a little bit more difficult than if you were trying to, say in a business setting, try to see how much savings you're going to get just from an efficiency type of standpoint, because you do want to take into consideration in this kind of calculation, try to quantify just how the dishwasher is going to make your house look better, and or the efficiency that's going to be involved in it. What's the value of it to you, in essence, in time, efficiency, and just other value for you. Try to annualize that, and then you can do the same kind of calculation for this net present value. Once we have the cash flows, meaning we got the outflow up front of the $3,000, the inflows in value we're assuming measured in dollars of the $1,040 per year, then we can do our 5-year net present value calculation. The next thing to think about is the discount rate, meaning the benefit we're getting today if it was dollars, if we're thinking in terms of dollars, is generally worth more than benefit that's going to be up into the future, possibly in terms of opportunity cost, because if we were talking about dollars, we can take that benefit we're getting today and invest it and get a return on it, and or at least in terms of, you know, the inflation, the decrease in the value of the dollar is something that we could take into consideration. So once we have this broken down into basically dollar values and flows, then we can use this rate and do our net present value type of calculation with it. So this is this is a similar kind of tool that we'll use for any other kind of big purchase that's affecting multiple periods, such as a car, which would be another kind of common example that you might use something like this with. So we'd have the present value of an annuity calculation would equal the negative, and we're going to use calculations related to present value or time value of money. If you want to practice those time value of money calculations, take a look back on our time value of money section where you could just focus on those tools, and we're just going to use those tools as applicable going forward. So it's going to be negative present value, then we're going to pick up the rate. The rate is going to be that 4%, comma, the number of periods. The number of periods is going to be 5, and then we're going to say, comma, the payment that we're going to have is going to be that $1,400, and that's going to be the benefit we're getting over the 5 years. So if we bring that back, discounting it back to the present value, that annuity at 4%, we're at the $4,630. So instead of saying 1040 times 5 years, which would be 5,200, we're discounting it back at the 4% to value it at the 4,630, so that we can compare it to the current dollar amount of the dishwasher, the money going out, so that we have kind of apples to apples, outflows in terms of today's dollars and the inflows in terms of today's dollars. Subtracting that out, we get the 1,060 net present value. Now note, when you're doing this kind of calculation, you're trying to determine the rate of return here, which will generally be the rate at which you would accept the project or not. So meaning you want to set this rate of return including the rate of return that you think is going to be enough for you to accept the project. Therefore, that means that if this number down here is anything above 0, then you may then say it would be a positive thing because you're clearing the rate of return, which in this case we had the 4%. So if this was negative, you would not be clearing the 4% rate of return. That's typically how you would set this up in like a business type of setting. So obviously the higher the number, the better, but any number over 0, in other words, cleared the 4% rate of return, which typically we would set at the minimum rate of return that we would think we would want in order to take on the project. Now, another way you can do this, and this is a way that, like if you have more complex scenarios in the future, and you say that, and if you say that there's cash flows or benefits that are happening in the future possibly that are different in nature, they're not all uniform, so we can't just do an annuity calculation. Or if you have cash outflows that are different because you have different costs that are going in the future, then you can't just do a simple annuity calculation. You'd have to do present value calculations for each period, this being 5 periods, which would be tedious to do by hand, but quite easy to do really in Excel if you set the table up properly. So you can kind of test this out with some tables and put this into Excel. We do work this in Excel, and what I would typically do is put the periods on the left-hand side in a column format, 0 to 5 periods, and then that's going to help you to set up your formulas in such a way that it will be easy to copy them down. And then we're going to say the amount on the outflows. The outflows I'm going to set up as negative, so that would be this $3,000 that we're going to pay up front. And then the next things we'll have are the inflows that are going to happen at the 1,040 for the next 5 years. That's the benefits that we think we're going to be getting. Then we can do our present value calculations. And the first one, I'm going to do a present value calculation even though we're going to get to the same number of 3,000 because it's at time period 0. So we're not pulling back the value in the future back to the present at that point. But I still put it there because it makes it easier for me to copy it down and makes the whole cell on the right-hand side kind of a uniform type of calculation. So the second one you can see, obviously, it's the 1,040 benefit. If we discount it back 1 year, we're going to bring it down to 1,000. The first one, I'll do the calculation here just so we can see it. The present value would be negative present value, brackets. We're going to take the rate. The rate, it would be then that 4%. So the 4% rate, we're going to make that. Notice I made it an absolute reference. So when you do this in Excel, and we do work this problem in Excel, if you want to take a look at it, we put a $ before the B and the 6 so that when we copy it down, that cell does not move down as we do the copying down. And then we say comma, the number of periods. The number of periods in this case is 0. Note that we're pulling that 0 from this column. That's going to make it useful so that when we copy this cell down, it will move down to the next cell of 1. That's instead of hard coding or typing in the 0 here, that allows us to copy it down and do this one formula and then copy it down. And then we say comma, payment. There is no payment because that payment function is used if it were an annuity, and this is not an annuity, therefore simply 2 commas. And then we pick up the future value, which will be the 3,000. Now, of course, again, it's at period 0, so there is no, it's the same time period, so we come up to the same number. But when I copy that down then, and we have the same formula for the next one, we got the negative present value of the rate, which is the same cell, B6, that 4%, comma, number of periods, which is now going to be 1, because this cell moved down from 0 to 1, comma, the payment, we have no payment, so 2 commas, future value is going to be that 1,040. So if we discount the 1,040, 4% back 1 year, we get the 1,000. If we continue that on, then if we discount at the 4% the 1,040 2 years back, we get the 962. If we discount the 1,040 3 years back at the 4%, the 925. Discount the 1,040 4 years back at the 4%, 889. And discounting back the 1,040 5 years back at the 4%, the 588. So then if we were to add up this column, we could say, all right, that's going to give us, I'll add up the positive numbers first, 1,000 plus the 962 plus 925 plus 889 plus 855 minus 3,000. We get to that 1,630. There's our with about 1,630. It's rounded. Same number that we got to up top. So that could be, again, it's a useful tool. And obviously, in order to use that kind of tool, you got to make the assumptions in terms of what your benefits are going to be in the future and your rate of return kind of assumption, discount rate or required rate of return. What kind of return do you want on your investment in order to say that that's going to be something I want to put my money, into, as opposed to doing something else with your money and or time, because we're measuring the benefit in terms of dollars. Now, the next thing you might say is, well, what if I compare that to something else? Maybe I'm going to buy some other thing or a different dishwasher or something like that, or try to figure out what my benefit will be, possibly to something else that has a different set of years that I'm going to get paid back in, or possibly has a different amount that I'm going to put down up front. And you can make comparisons if you could break it down to something like that, like this, where you have different options that you can possibly be putting your money into, and typically the one with the higher amount would generally be better, but any amount that clears the hurdle rate, which is that 4%, can be beneficial. Now, you might then think, well, if I do this calculation, what is my rate of return to get this number to be 0? In other words, if this discount rate is the rate of return that I'm looking to clear in order to see if I take on the project, and this is what I get to when I run this cash flows, the inflows and the outflows, then what would the rate be in order for this calculation to be 0? And that'll give me what we call our internal rate of return, kind of the rate of return on this particular project. And there's a formula to do that if you wanted to calculate that. In other words, you could say, let me adjust this cell from 4% up to 5% to 6% and so on until this number gets to 0. And that will be basically, in essence, on a percentage basis, your rate of return on the project that you're projecting out on the purchase. Or you can use this IRR function, which will kind of do kind of a goal seek type of thing to get that number. So in order to use this function, you need to set up your series of payments with negatives as the outflows and then positives as the inflows. And then you just use it just like the sum function. In essence, you just say equals IRR and then bracket it up and do that calculation similar to the sum function from the 3,000 down through the 1,040s. And that will then give you, in this case, the amount of the 2166, which would be basically the rate of return that we're calculating or assuming based on this flow of inflows and outflows. And we can prove that by doing this same calculation here that we did, but using this 2166, resulting in an end result of 0 at the end of this whole thing. So in other words, if I was to take this first one, we'd still have the 3,000 because we're at time period 0. Second one, we're going to say present value, the rate now, 2166, comma, number of periods 1, comma, because we don't want an annuity present value of 1, so we got future value of the 1,040, the 1,040 discounted back at 21.66%, 855. The 1,040 discounted back 2 periods, 2 years, 21.66%, the 703. 1,040 discounted back 3 years at 21.66 is 578. And the 1,040 discounted 4 years back at the 21.66 is 475. And discounted 5 years back at the 21.66 is the 390. Adding that up, let's do it with the trusty calculator just for the fun of it. Trusty calculator. This is going to be fun. I can't wait. We're going to add up the positive number for 855 plus 703 plus 578 plus 475 plus 390 minus 3,000 gives us about 0, right? And that's kind of our proof that that's basically that internal rate of return, the rate of return that we're projecting on this particular project. Those are the two time value of money kind of tools that can be useful in a lot of areas. Budgeting, if you're budgeting out into the future and whatnot, or making large purchases, or comparing or contrasting, putting money in one thing to the other and comparing what you think the benefit's going to be out into the future. Again, the difficulty with this on the personal side is that you're not measuring it on the strict basis on a business side, which is usually measured in terms of cash flow, right? Revenue generation, but in terms of benefit that you're going to be receiving, which you have to measure in dollars so that you can use the measuring tool of dollars in order to do the calculation.